Welcome to accounting, guys. So once again, we are diving right into the accounting and bookkeeping section of the class where we're going to be learning on how to do financial accounting, which is the very basics and the very backbone of business, right? We need to understand the basic concepts of what a business is and how it's being run, okay? And that's what this class is for. So today I'm going to be introducing you to what accounting is, okay? All right, so first things first is this is going to be the list of things that we're going to be learning in this class. So the introduction to accounting, right? We're going to take it a step back as if we've never heard of accounting before, or if you're learning about accounting for the very first time, okay? So all terminology are all going to be new, okay? But in this case, these are the concepts that we're going to be learning in this class. So 15 weeks, we're going to cover, okay, number one, which is the basics of accounting, all right, which is basically how to collect, how to record, how to journalize, and how to post to the ledger, right? We're also going to learn concepts that, for example, the accounting equation. We're going to be learning about the generally accepted accounting principles which govern the rules and guidelines on how to journalize and why to journalize, all right? We're also going to be looking at a merchandising operation. So in this case, right, the very basic kind of business is first, let's try to sell a product to a customer. And then from there, if you want to build your own product, that's where you can do that as well, okay? So that means we're going to be taking a look at how sales works and how we increase or how we obtain revenues, how to purchase inventory. So we will be dealing with inventory, all right? And how we actually collect our sales, all right? And then we're also going to be learning how to create our financial statements for the purpose of, remember, if you guys remember those financial statements, your profit and loss is to determine whether your company's doing good or whether your company's doing bad. And last but not least, we're also going to be taking a look at payroll. Payroll is very important because, again, it is one of the largest parts of running a business, right? If you guys remember from QuickBooks, you got your customers, you got your vendors, and you got your employees, right? Those are the three main sections that you are going to be dealing with as you own a business, right? You need customers to sell the products to, you need vendors to purchase those products, and then you need to have employees to work for you because you won't be able to manage the company by yourself if you are just a one person, okay? All right. So let's go ahead and talk about what the different business organizations are and what exist, okay? So in this class, we're going to talk about, first off, what is the nature of the business, okay? This is why we want to establish a kind of business, because in order for us to even establish a business organization, we need to figure out two things, okay? What is the nature of the business, right? Our goal as a business is, if we choose to be a for-profit business, we need to make money, okay? So the objective of most companies, right, is to sell a product to consumers, right? But at the same time, maximize savings or maximize cost, or lower the cost, okay, in this case. Right, you want to make sure you want to maximize your savings by, maximizing the lower of the cost, right? Don't cost so much money, but instead we increase our prices to obtain a profit, okay? So the definition of the nature of a business is, for a business, right, in order to be, to run its business, we need to be able to use its basic natural resources to either create a product or provide a service, okay? We do that for our customers, okay? So again, our goal, our main goal, as most businesses are, is to make the money, okay? Especially when we're looking at any type of business, right? If you're trying to sell food, right, you definitely want to make sure you have some extra money so you can, be able to either expand your business or, maybe establish yourself as a different organization. Maybe you want to move up the corporate ladder, right? Maybe you want to go from a small business to an LLC, then to a corporation, okay? So the main goal here is to make money, right? Now again, we're going to talk about 5 different business organizations, okay? And they are sole proprietor, partnership, corporation, limited liability companies, which is known as LLCs, or we want to look at a non-profit organization, okay? So each one, after this slide, I'm going to talk about the pros and cons, and yes, pretty much pros and cons for each and every single one. But what I'm going to tell you here is that for this class, since we are starting from the very, very bottom and we're building our way to, learning about how a business runs, we're going to be taking in perspective of a sole proprietor, a small mom and pop shop kind of type of business, right? Where there's only one owner, and how does that one shop, operates and runs its business, okay? So that's what we're going to be taking a look at. It's just a small sole proprietor type of business. There's a lot of things that you need to learn if you go up and start learning about corporate, okay? Corporate, there's tons and tons and tons of rules and regulations, especially just because the corporations, they're governed, right? Or they're being watched by the U.S. government, okay? We'll talk about that in a few minutes, okay? But first, let's go ahead and make sure that for this class, we're going to learn all 5 different business organizations so you know what you can become or what you can establish yourself as. But ultimately, this class is geared towards a sole proprietor type of business. We're looking at a small business and what the small business has to go through in terms of, starting up their company. What do they need? What do they need to purchase? Et cetera, okay? We're not going to talk about corporations at all, except for learning what they are. Okay? So number 1, we're going to talk about sole proprietors. Now, the definition of a sole proprietor, right? Sole meaning one. Therefore, there is only one person who owns the entire company, all right? If there's 2 people, right, then you're technically a partnership, okay? Unless you guys are technically married, then, if you guys establish together as one owner, then yes, you can. But the better output would be you to go into a partnership. But in this case, sole proprietor is just one and one person only. So that means in the eyes of the government, you and the business are one. Okay? Meaning, so if anything that you do for the company, it's going to reflect what the company does. So again, you and the company are one individual or one business. Okay? So that means the owner is responsible for all liabilities and they own all assets, and every earnings that they've made, it's all that person's, right? Because they are the sole owner of the company, all right? Now, here's a little fun fact that you do need to know. If you do, potentially want to establish a sole proprietorship, you do need to know this for at least for IRS purposes, right? Especially because when you are a sole proprietor, we'll talk about this, you get special taxes, okay? Not super special taxes, but you get to write off your taxes as off of your personal taxes, okay? Now, here's the catch here, because IRS isn't going to give you free deductions for no reason, okay? The IRS expects you, if you're going to establish yourself as a sole proprietor, you must make or you must claim at least profitability 3 out of the 5 years that you are doing business, okay? So the first 5 years, 3 of those years, you must make a profit. Because if you don't, it's going to be considered a hobby, okay? And if it's a hobby, then nope, you do not get any special taxes because you're just building a business for the only sake purpose to, share your hobby. And that's one thing about IRS, and that's what prevents IRS from, from people trying to take a tax break because they get to own their own business. No, there's a price that comes with owning a business, and that is if you do not make a profit within 3 out of the first 5 years you do business, it's going to be considered a hobby, and all those taxes are going to they're going to come after you for your taxes. Okay, that's just a little fun fact. Okay, so if you do ever think about going into business, you might want to consider and make sure that you thoroughly do your research, especially going on irs.gov to make sure that you be opening a sole proprietor or just opening a small business in general is what you want to do. Right? There are rules and guidelines on what you can and can't do. You can't just establish a business out of nowhere and take all the tax benefits. Okay? All right? So let's go ahead and talk about the pros and cons, or the advantages and disadvantages, okay? Let's talk about the advantages first, okay? Positive and good things about a sole proprietor is it is the most easiest and cheapest form of business that you can apply for, okay? In the state of Nevada, if you go to, I don't remember what the website is exactly, but if you look up in your Google, just look up on Google, Nevada Business State License, or you're applying for a state business license in the state of Nevada, the site will pop up. It only costs $100, and it's pretty straightforward. All you have to do is just fill out your information, right? And it's the easiest one because it takes about anywhere from 15 to 30 days to get approved. Of course, they run your background check, right, to make sure that you're not a criminal. But they also do credit score checks as well to make sure that you are capable of owning a business, right? And you are capable of making those payments back in case you do take a loan out, okay? So once again, it is so easy to obtain a business license. And once you do that, right, you're going to receive your business license in the mail. And that's it. So, pretty easy. The application's online. If you want to be legitimate, you can go to the local state agency, whichever one that there is that you are going to go to, whether it's DETR, right, the Employment Training Resources. That is basically where you report what employees you have, but that's also where you could also apply for a business license as well. You can go to the IRS, right? They help you file a lot of forms, especially when you are applying for a business license, because not only are you applying for a business license, they will also have you also apply for the employer identification number so you can properly file your taxes as a sole proprietor, as a small business owner, which then again, you can also file that as part of your extra deductions that you can take. Okay. Easy. So once again, it is the easiest form of business to even establish and start. Okay. If you look at a lot of how many small businesses there are that are just mom and pop shop or small sole proprietors, it's definitely more than corporations for sure. Right? There's a million people who want to open up a small shop and do businesses. Okay. Number 2, owner has full control of and they can make all the decisions that they want to in order to run the business. So again, this is important because if, the individual likes power, well, they get to make all the executive decisions. So all decisions have to go through the owner because the owner owns the business. He's the one that makes all the decisions, all the rules on how they want the business to be run. So once again, the owner has full control of and to make all those decisions to run the business itself. Okay, so a lot of power and a lot of control. So if this person wants to strictly only have 1099 workers, they can do that as well. Okay. Number 3, owner can keep or reinvest their profits, earnings, okay, from the business. So once again, when we talk about the accounting cycle, when you go through the accounting period, right, where you measure your profitability, right, every penny that the company owns, the owner gets all of it, okay? Now, here's the thing, though. If you are a small business, right, you shouldn't just take all the money that you profited, because at the end of the day, that money, right, should actually be reinvested into the company, because again, the more you invest into your own company, the more opportunities you have to expand your business, right? Maybe to make the workload less heavy on you, you hire more employees. And by doing so, you need to reinvest your profits, okay? So again, but that's the thing here. The owner owns every single penny that they earn. So through sales, if they make a profit, every penny that's earned is the owner owns it, okay? Okay, so that's a good advantage because, again, the purpose of a business is to make money. And what's so great about having the owner own the money is that means that money's yours. Once you earned it, it's yours. Okay? Number 4, personal tax deductions. So like I mentioned before, because you own your own business, you can apply this as a part of your tax deduction because you're investing your own money into your own company. So therefore, you get to take a little tax break here for owning your own business. Okay? And then last but not least, it is very easy to dissolve. All right? All you have to do, go to your bank, close out your bank account, tell the IRS or tell whoever, the local agency that you're done doing business, tear up your business license, and that's it. Okay? Now, of course, you want to make sure that when you do that, that you're not in the hole for anything. But if your company does end up going bankrupt, it's, once again, easy to dissolve. Okay? There's no no paperwork that's really necessary to actually close your business. It's pretty easy, straightforward, and yeah, it's very easy to establish. It's also very easy to dissolve. All right, as you can see, a lot of sole proprietors or small businesses, it's easy to just stop doing business. Okay. All right. Any questions in regards to any advantages for a sole proprietor?
No.
Okay, good. So then let's go ahead and talk about the disadvantages of being a sole proprietor. You are 100% responsible to pay any liabilities or debt that you owe, okay? Meaning, if you owe a loan for $50,000 and you take that loan, right, and you decide to pay yourself off and you bought yourself a car, right? Therefore, if you still owe money to that bank for that loan, you have to still pay for it no matter what you buy, all right? No matter what you own, right? here's the second part here is that anything that you own is going to be the same thing as part of your business, because we have the idea that you and the business are one. So if you owe so much money, right, and your company that goes underwater, what happens is that all your personal assets are going to be at risk. So if you ever seen those movies where you see that the house is repossessed, the cars, it's usually because someone's doing bad business and they either file for bankruptcy, and if they are doing a business, all of their personal assets will be the first thing that goes. Okay, well, usually goes the business assets first, and if it's not enough to cover it, then they go over personal. Okay, so all businesses and personal assets are at risk. So once again, anything that you own in the business that has some value, all of those go first. They're going to get repossessed first, and until they have enough money to pay back whatever that you owe, and then they'll go after your personal assets. So they could go after your car, after your home, after anything that they can get their hands on, if the owner decides to not pay for the liabilities or for the debt. Okay. Third thing here is going to be limited to only using personal savings or consumer loans. So, yes, you can apply for a small commercial loan, right? Usually it's for like a small business loan that you can acquire, okay? Usually those are like less than $50,000, or like probably like $25,000 to help you get your company started. I believe Upstart is one of those bank loans that you could use to establish your business, to start your business. So that's probably the most that you'll get out of there. You wouldn't get any any exclusive or any bigger loans out there than a small consumer loan. Okay. Other things too is you're only limited to your own personal savings, right? You need to have money in order to establish your own small business. Okay. You can't rely that all of your money is going to come from just the business loan alone, because if a small business loan only can give you about $25,000, right? It's also based on your credit score. Are you able to pay this money back? So if that's the case, then $25,000 can barely get you. It can barely get you by. All right. So definitely, the bad thing about that is you do need, unfortunately, to have some kind of lump sum of your own money to kind of help you, create and run your business, right? Number 4, does not attract any high caliber employees, all right? Because as a sole proprietor, you don't have that much money to spend, and especially as we talked about in QuickBooks, right? When we talked about employees, right? What are the benefits that you can offer your employees? In this case, as a small sole proprietor, you're more likely to not be able to afford 401k plans. You might not even be able to afford overtime, or let alone a full-time employee. You might have to put them as a part-time employee, or in this case, right, you can't provide any benefits for them except for their standard ones that their federal mandates for them. You can't provide health insurance, right? And for most people, right, working for a company that doesn't provide health insurance is kind of it's kind of bad, because then you have to go out and apply for your own medical insurance, right? So in this case, right, the money that you might not even be able to get paid that much either, right? You might get paid the minimum wage, which right now is, I think, it's like $10 or something right now, right? So right there, that is why you would most likely not get really hardworking type of employees, because they're not going to be able to pay for you. They might not even be able to pay for any benefits for you. So why would you want to work for some kind of company like that if you're not getting anything out of it? And then last but not least, employee benefits are not fully deductible to the business. So once again, when we talked about sole proprietors and offering those kind of benefits or deductions, it technically, it's not so much that you can. Unfortunately, you won't be able to use that as a tax deduction. Just because you're already taking it off as a personal deduction off your own taxes. So it might not be one of those things that you can take off as a deduction for your business. So those are those are going to be disadvantages to owning your own sole proprietor business. Okay. Any questions here?
Just curious, you're supposed to have two bank accounts separate, personal and business, or you can have just one because you're your own owner?
Okay. So in this case, yes, and we'll learn that in chapter 4.
Oh, okay.
Okay. Where it's wise, it's best that you keep your personal and your business separate accounts, right? So then when you do your personal taxes, right? But in this case, right, there's a lot of rules and guidelines on what you can do to determine whether it's business or personal, right? But in the eyes of the IRS, you and the business are one. But the best way to keep track of your business transactions is by separating, having a personal bank account with versus a business bank account. That way it's easier. But most cases, right, if you're going to apply for a business bank account, your name, the owner's name is going to be on there. Okay? Because the owner has the authorization to be able to use that business bank card. Now, but however, it doesn't matter if the business owes a lot of money, you know.
It's the same for you.
It's the same thing as exactly. So if you go under the waters, right, you owe $100,000, they're gonna go after your business assets first. So whatever they can liquidate, they will liquidate, and then if it's not enough, they're going to go directly to your personal assets. So if you took the money from the business to go buy yourself a brand new car, you can expect that car to be gone, would be the first thing to be gone. Okay? So that's the tricky thing about being your own sole proprietor, is that all of your assets are not protected. Okay? So it's very tricky to do business.
Yes.
Okay. Right. Any more questions? Okay. So let's go ahead and move on to partnerships, okay? Partnerships, pretty straightforward, right? It's a partnership is where you have two or more people who own the business. Okay, so we have two types of partnerships, right? A general partnership, okay, which is a common one, or a limited liability partnerships, which you are more likely to be commonly seeing this, also known as an LLP, right? Now, the difference between them, okay, is, well, as a general partnership, whether it's 2 or 3 or 4 partners, doesn't matter how many, as long as you have more than one, okay? As long as you have just 2, right? That's the definition of a partnership, right? You have to split up the work evenly or write up an agreement on how much each person is responsible for the company and how much each person is responsible for splitting up the profits, okay? The partnership could be 20-20-30. I'm sorry, no wait, 20-20-40. 20-20, I'm not doing math right. 40-40-20. There you go, 20-40-40, okay? Or most cases, it's 30-30, 30-30-40, okay? Or that's just if you have more than 2 people, right? 3 people. But if you have just exactly 2 people, 50-50. Straightforward, right? 100%, and you divide the responsibility based on what it is. Now, yes, you can have a person do 60% of the work and then the other one does 40% of the work. Whatever established or contractual agreement you agree on, as long as you guys are doing the work in an even manner. You're splitting up the responsibilities and the profits evenly, as even as possible. Okay? That is a general partnership where both people, or 3 or 4 or 5 people, do the work to run the business. Okay? That's a general partnership. Okay? A limited liability partnership, which is probably the most common one that you will most likely see, right? There's a lot of LLPs out there. And what it does is one person is the general partnership. They're the one that's running and operating the business. While the other partner, their only contribution to this partnership or to this organization is that they are there for pure investment. And if they're just there for pure investment, all they're only responsible for is whatever amount of money that they are invested in, and whatever amount that they get profits for, they take that profit. Okay? That's also known as a silent partner. That person that acts as the investor has nothing to do with the business, has nothing to do with operating the business. They are just going into business to help the other individual be able to operate the business, right? By helping fund them or act as an investor. Now, again, this is very common because it's true, right? If a sole proprietor of an owner, right, wants to do business but can't do business because they want to make sure that they kind of don't they can't take full responsibility for everything, or they don't have enough money to invest into their own company. They look for a partner who wants to just have nothing to do with the business but has the money to invest for you, right? And all they ask in return is just a profit of the business. Then that's where limited liability partnerships usually form, right? It's where one person, at least one person, is a general partnership, while the other partners is either a silent partner or could be, someone who actually works at the actual company as well. Okay, so at least one person must be the general partner who runs the whole show, does all the main core operations, while the other person is a silent partner that just merely invests in the company. Okay? All right. So, any questions in between the differences between these two partnerships?
Nope.
So then we'll dive in the advantages and the disadvantages. So they're a lot more shorter, okay? So let's talk about the advantages first, okay? Once again, it is very easy to establish. However, the agreements involve time. So what does that mean? If you're going to go into a partnership, you need to rule out everything that you can possibly think about when you go into a partnership, right? You can't just be like, hey, yo, buddy, you and I, let's run a business together, right? Okay, you guys say yes, right? Because then when you go down into the business together, all of a sudden you're saying, well, why do I have to pay for this? Why do I have to pay for that? Or why aren't you doing this? Why aren't you doing that? This is exactly why a lot of times you definitely want to make sure you go into some kind of contractual agreement so you guys know exactly what you are responsible for, what your agreement is, and what you have to do in order to be involved into the company. So this agreement right here doesn't come out of thin air. It doesn't come up in 5 minutes. No, because you need to outline responsibility number 1. What is your responsibility? All right. Are you going to be taking care the purchasing part? Are you going to be taking care of accounts receivable? Am I going to be responsible for payroll? Right? How do you want the profits to be split? You want 50-50? All right, that means you got to invest 50% of your money into the company. That's the only way I can justify as a 50-50 agreement on profits. Okay? Other things too could be, okay, well, if not, then why don't we just invest our own money, and then whenever I get my money back, then we'll talk about the agreement afterwards. So again, agreements take a long time because you have to go through ins and out. What happened if the company dissolves and we go into a lawsuit? Are we going to be responsible? Who's going to pay for the damages? Are we both responsible? Is it going to be based on who faulted? All right. So there's a lot of things that you need to talk about, especially when you're signing a contractual agreement if you are going into a partnership. Okay? You never want to go into a partnership without signing anything, right? It's like a marriage, right? You know, sign a prenup, right? So then when things happen down the road, you know exactly, you have it written out in actual legal documents. You guys both signed it with your legal agreement that these are the terms that you're going to agree upon, and so on and so forth. So once again, same thing here. You just go to the Nevada business license. You apply online. Same thing there. You'll apply as a partnership, and it's that easy. Okay. The only problem is you need to go make sure you have your lawyers go through the contractual agreements with each other. So in case anything happens along down the lines, those are the fine lines there. Okay. Number 2, ability to raise funds. Yes. Obviously, if you have more than one person working at your business, that makes it twice as much easier to make your own money. So what does it mean by raising funds, right? One person can claim their own personal loan that they can apply to the business, right? Another one could be a sales representative that goes out on business trips to gain more money. So you have 2 outputs that you're able to earn the money and generate it a lot quicker, right? The ability to raise the funds would be a lot quicker, okay? Number 3, tax deductions for profits. Okay, yes, because as a partnership, you do get special taxes for profits. Now I'm going to tell you this. I do not know the specifics on every single tax item, what tax you can take, because I am not a tax accountant, okay? I am just a financial accountant, okay? I only do financial accounting. I do not do tax accounting because, 1, I am not a CPA, all right? And 2, tax is very hard, okay? There's a lot of rules and regulations, and especially with tax changing every year, I am not a tax accountant. So if you want more information on what these rules and guidelines are and what you can do for taxes, I would recommend you to go to irs.gov and you type in publication 15. It will tell you everything about running a business, what does it take to run a partnership, and what taxes are involved, okay? So once again, I don't know what the specifications on those special taxes are, but you do get special taxes on those profits. Okay. And number 4, hire employees that may be a potential partner. So, yes, very, very common, especially if a mom and pop shop, right? Maybe they decided to open up a little mini shop and they don't have any bloodline or any kin, no daughters, no sons, no anything, right? And they're getting older and older and they're getting tired of doing the business and they don't have anybody else to pass on the business, right? So that could be a potential for, hiring an employee. And if this employee is very dedicated to that company, they could sign that person as a potential partnership to part own the company. So yes, so that's a good thing about partnerships is the availability and the opportunity could come across where they could be a potential partner for the company. What about the disadvantages? So, number 1, are responsible for each other's partner's actions and decisions. So, once again, if you're going to go into a general partnership where it's 50-50, right? Here's a little fun fact, another fun fact. So, by law, okay, if one partner decides to make an executive decision without the other partner knowing, that decision can be revoked because both partners must agree on that decision. Okay? And if both partners do not agree, the person who did not know about that decision can revoke the other person's decision. So therefore, this decision or this agreement must be on both parts. Now, what if another example is, what if the partners needs to go on a business trip, right? But they know about this business meeting where the executive decision is that they want to proceed with this other decision, but both partners know about it and they both agree on it, then that is a valid decision, okay? Now, again, that also ties in, what if that decision was a bad decision, okay? Well, then both partners or whoever's the partners of that company, they must follow through, because even if you didn't agree to it, but you said, fine, let's try it, you're going to be still responsible for it, because whatever partners, whether it's you or the other partner, does a decision, and at the end of the day turns out to be a bad decision, both of you have to go through the consequences yourselves. You can't just be like, well, no, that's the partner's responsibility. You and the partner are going to be together if it's the general partnership. Okay? So that means whatever decision that each partner makes, unfortunately, you have to go through with all the consequences, and, in case things happen, you have to be able to accept all responsibilities for it. Okay? Profits are shared. Right? If you made an agreement that all the profits and earnings that you made for the company, you have to split it. It's shared. That's the whole purpose of being in a partnership. You cannot reap 100% of the profits. And even for a limited liability partnership, you still got to share half your profits with the person that's helping you operate your business by investing into your company. So at the end of the day, you're not going to get all 100% of the profits. It's going to be split and shared, okay? Which is a bad thing because, again, a lot of people want money for themselves. Okay? Number 3, the most common one, and that's why exactly you need a contractual agreement, because disagreements will happen, okay? Disagreements will happen because one partner might like an idea, the other partner might not agree, all right? That's reality. That's the same thing as a marriage too, right? One partner likes this thing, the other partner doesn't have to agree, okay? So again, that's why you have that contractual agreement. So then when you guys dispute this disagreement, you guys know how to resolve it, okay? Again, some employee benefits are non-deductions to the business. Once again, as a partnership, right, it depends on what kind of deductions that you have. So some of them could possibly be deductible, but not everything could be deductible for the business. Because again, as a partnership, you are getting special taxes anyway. So, and then last but not least, limited lifespan if a partner decides to leave. Yes, if the disagreement gets so big that the partner decides to up and leave out of the business, and let's say there's 2 of you, right? If one partner leaves, therefore, now it's just you. You can't continue as a partnership if you don't have 2 or more people. So that's where a lot of times, this is where last resorts, they'll go into a limited liability partnership where the other person is going to come in as an investor, to become a silent partner to help you continue doing your operations. Okay. But yes, it is very easy for someone to just walk away. Even if they have a contract signed agreement, they can walk away at any given point in time. They're not obligated to, they're not mandated to stay or obligated to stay. They can up and leave whenever they want. Okay? Any questions in regards to partnerships?
Nope.
Okay. All right, doing good on time. All right, the next one is going to be the most big ones that you guys normally see, which is corporations. Pretty straightforward. Now, corporations, they have 4 characteristics to establish as a corporation. Okay? Number 1 is that nobody owns the business because everybody owns the business, right? Shareholders are going to be, that's what they have. They have shareholders, which are a bunch of people who basically invest a small portion of their own money to have some kind of ownership of the company. Okay? There is not one person who owns it, it's a bunch of people who own it. Okay? And when that becomes established, right, each person who, has a small portion of the company, they are limited to holding responsibility for anything that happens to the company, right? The only thing that they're responsible for is whatever money that they invest, okay? So in this case, right, shareholders, right, they can own as many shares from any bunch of companies, right? And they're only responsible for the money that they invest. So if the company goes down, the only thing that the shareholder is responsible for is basically they lost the money that they invested. That's it. Their personal assets are safe. Nothing is harmed except for their own money that they put in there. Now, again, that's a good thing, but that's also a bad thing if you own 50% of the shares and that's like $1 billion, right? Something like that, right? Then yeah, that will hurt a lot. Okay? Second thing is going to be is having some kind of central management. Now, as a corporation, we call that the board of directors, okay? These board of directors are elected by the shareholders themselves, okay? The shareholders will have some kind of annual shareholder meeting where they discuss on who is the perfect candidate to hire or elect them as the president of, or in this case, the chief executive officer, right? The CEO of the corporation. Yes, they can elect whoever could be that position, okay? All right. And then number 3 is transferability of shares, right? You transfer profits through dividends, okay? So if you own a share, right? The board of directors is going to make an executive decision to whether to either pay those profits out to those individuals who own a shareholder and distribute the profits through dividends. Okay. And then last but not least, number 4 is continuality of life. Okay. So that means no matter how many shareholders exist, okay, the company, the corporation, the business itself will continue its life even if there's only one person who owns the entire stocks, okay? If everybody's jumping sail and selling their stocks out, right, and there's only one person left, they can continue on to carry out the corporation, okay, as long as there's just one person, okay? So think about many businesses out there who are established as corporates, right? How many shareholders do they have? they can have anywhere from thousands, hundreds of thousands, even millions of shareholders. So think about it. If it boils all the way down to just one person, think about how long the corporation life could be. Right? All right, let's see. Okay, a little fun fact here is when you usually establish yourself as a corporation, you definitely want to, it's a little fun fact here that usually when you establish your corporation, right, whatever state that you are in is going to determine, and whatever state that you apply for corporate status is usually going to be wherever the headquarter office is going to be. Okay, it could be established in New York, in Nevada, okay, in Las Vegas, right? If there's a headquarters there, then then that's where it's going to be established. But usually it's one place, and whatever that their corporate business building is usually, or wherever their headquarters are, is usually going to be the state that they are incorporated at. Okay, just a little fun fact there. Okay, so let's talk about advantages and disadvantages of corporations. Okay, number 1. Okay, shareholders have limited liability. Yes, that is a great advantage, because if, let's say, I want to invest $5,000 into Target, right? I'm only responsible for those $5,000. Okay, if Target decides to go down in business, then my only responsibility is that I just lost that $5,000. My personal assets, my car, my home, my computer, my laptop, anything that I own personally are not going to be touched at all, because I'm only restricted to my original investment into the company. So that is a very good investment, because therefore I'm not responsible for anything except for my money. Right? Number 2, shareholders are only held accountable for their investment in stocks of the company. So once again, that goes along the lines of part 1, right? They're only responsible for whatever amount of money that they own to or invest into the company, right? Limited liability, nothing can go after their personal assets. Okay. Number 3, ability to raise additional funds through sale of stock. Yes, if the corporation needs more money, all they have to do is simply sell more stock. Okay, and they usually have like a 2-for deal or a 3-for deal, where they say buy one stock, but for the price of one stock, you get 2 shares. Okay, so again, if they just need money, all they have to do is just market and sell more stocks. Okay. Number 4, tax deductions for having employees. Yes, right? It is a huge tax deduction for having employees as a corporation. Okay, why? Because you could get taxed at both the corporate and the income level, which we'll talk about that in a couple seconds. Okay, and step 5 says, or part 5 here says, that they can elect to be taxed as an S corporation. Okay, now let me tell you this. An S corporation and a C corporation are not 2 separate entities. They're not 2 different things. The only difference between them is how you're being taxed, okay? They're not separate organizations. They're not separate entities. The only reason they're just different, they're only different is because the way that they're taxed, okay? But yes, okay, on paper, you do need to establish yourself as either an S Corp or a C Corp. But in this case, right, in context, to kind of make this clear and make it easy for you guys to understand, the difference here is how they're taxed. That's it. Okay? So when we talk about S Corp versus a C Corp, C corporation, they get taxed twice, right? Once at the personal income level and one as the corporation level, okay? So meaning that not only do they get taxed for the income, the personal income, so any stocks or any profits that they earn, they get taxed at. And then on top of that, they get taxed at the corporate level when they need to file, taxes to the IRS at the end of the year, right? Whereas an S corp, if you are able to establish as a S corp, you do get the privilege of getting taxed only at the personal level, not twice. You get taxed once. But most cases, right, as we all know, the more taxes you pay in, the most likely you will get a refund. The less taxes that you pay, most likely you're going to owe the government money, okay? Now, in this case, because the whole corporation has those two options to select themselves as either being taxed at the personal level or the corporate level, usually the corporation will have that extra money to just go ahead and pay for that corporate tax. Okay. Yes. Right. Now we'll talk about disadvantages, which, number one, requires a lot of time and money. Okay. Yes. Okay. Now, how do you develop and get to corporate status? You need to market yourself and build your brand name. Okay? Because the idea here is that if you're going to be selling stocks and you want people to own a part of your company, you need to establish your brand. Okay? How do you do that? Lots of time, lots of money, lots of ways that you have to be able to have people want to trust you to be able to invest in you. Okay? So that's the huge thing there is usually your go-to to start up a company is usually going to be you're going to start yourself off slow, start yourself off as a small business owner or an LLC, right? We'll talk about LLCs right after this. You got to start yourself from somewhere. You can't just automatically be able to apply as a corporation right away. It doesn't work like that. The only what do you call it? The only way that you could be able to bypass that is if you are expanding a already pre-existing corporation. If you're franchising, that's the only way that you can go ahead and do business as a corporation. But think about it. Franchising is going to cost you a lot of money. We're not talking about the thousands. We're talking about maybe hundreds of thousands or even close to $1 million for franchising an already pre-existing corporation. Okay? That's the only way that you'll be able to establish yourself as a corporation because you're already building off of a already established corporation. Okay? But in this case, you need to start from somewhere because you need to build your brand. And it takes years and years, okay? Target back in the day used to be a small grocery store, okay? Or a small convenience store, I believe it was. They said it was a convenience store. And then it took them long enough for people to like Target, to trust Target, right? They expanded their business over into other states and countries. Other states. And then they finally incorporated themselves, and now people can invest into Target. Okay? So again, you have to start from somewhere in order to establish yourself as a corporation. Number 2, it is monitored by the federal, state, and local agencies to follow regulations. And we will talk about this and why this is relevant because who wants the government to keep an eye on them, especially making sure that every business transaction that they do isn't frauding the company or frauding the government, okay? If you guys heard of the words, cook the books, well, I would tell you this, it's all because of Enron. If you guys heard of Enron, we'll talk about that in a second, which was a major electricity company that frauded their customers and also frauded the IRS. into thinking that they were a perfect business, only to realize that they were scamming the customers, scamming the government, not paying their taxes, XYZ. And that is exactly why we have the Sarbanes-Oxley Act, which is now why the government is, having a lot of interactions, or having their eyes especially on corporations, because they're so big and they're a multi-million-dollar kind of corporation that a penny here and there could be swept under the rug. All right? And you definitely don't want to do that. So that is why nowadays corporations have to follow regulations that are governed by either the federal or by the local agency that they are doing business in. Okay? So they have to play very, very hard rules. So once again, corporations is going to be one of the hardest types of accounting. So if you become a CPA, which we'll talk about later on in this chapter, you become a CPA, you need to do what's called ethics, which is what is right. All right? What necessary steps will it take for you to be honest and to be completely, moral into every transaction that you do? Okay? Because you're being watched by the government. And then last but not least, number 3 is high taxes if you are taxed twice. If you are considered as establish yourself as a C corporation, you could get taxed twice, which isn't very fun. Okay. Any questions in regards to corporations?
No. What you mean when you get taxes twice? What do you mean?
Okay, so when you are established as a C corporation, if the company makes profits, right, you get taxed for that. Okay? And then after that, when the corporation files for their taxes, you get additional taxed on that.
Oh, on the product, what you're doing, and the profit from the product that you're selling, or whatever it is.
No. Just for being a
Just
business.
no.
Just for being a
Oh, just
business
for
itself. Yeah.
Oh.
You have to pay lots of taxes if you're any type of business, right? Especially if you're any type of business that primarily earns money, right? You still got to pay taxes, right? For sole proprietors, that tax deduction could be applied as your personal taxes, but you still have to pay taxes for establishing yourself as a business, because you're ultimately making money.
Mm-hmm.
The government likes money, so the government's going to go after any type of business to gain their money, right?
Okay.
So in this case, that's why you get taxed twice, because if you establish yourself as a C corporation, not only do you get taxed at the personal income level, you get taxed again at the corporate level. Okay? All right.
Okay.
All right, so then now we have what's called a limited liability company. Now, this is actually another common one that you'll most likely see more often than for a regular partnership, right? Because once again, a limited liability company ensures that if you go into business, right, all your personal assets are not not going to be liable, as in all your personal assets are safe. If your company goes down, that's all you're responsible for, is whatever you invested into the company, and so on and so forth, right? All your personal assets are safe, which is a good thing. That way you don't have to use anything for collateral, right? Or your house, your cars, whatever that you own individually, they're going to be safe. Okay? Now, but let's take a look at what the definition of or what makes a limited liability company. Okay, so in this case, right, a limited liability company is a combination or it's a hybrid between a corporation and a partnership. Okay, it is not a corporation, but it is a legal company entity. So once again, because it is a combination between a corporation, it has characteristics like a corporation, but at the same time, it's also a partnership. So in this case, it's not an actual corporation. You're not going to be incorporated. However, you have certain features or certain characteristics that act like a corporation, but you really are a partnership. Okay, so the idea here, right, if you're a partnership, you need to have at least 2 or more people to be able to establish a limited liability company. Okay, but here we have to also consider that you can have at least 2 characteristics of a corporation. So that could mean, do you sell stock? Do you distribute your profits through dividends? Do you have a central government or a central system that helps you run your business? Okay? If you do, then you could establish yourself as a limited liability company. Okay? So once again, let's talk about advantages and disadvantages. So first one here is going to be your advantages, which right here, number 1, taxes, right? You can establish yourself as a corporate, or in this case, you can be taxed at as an S corp, right? Taxes here are flexible. Okay. Number 2, so that means you only get taxed at one level, which is the personal income level. Number 2, limited liability. So like I mentioned earlier, right? That means you're only responsible for the money that you invest into the company. Okay? All your personal assets are safe. Okay? Number 3, can elect one member to be the entity. Okay? So we talked about partners, right? It's a part of a partnership mix between a corporation and a partnership, right? So in this case, if there are 3 people involved, you can establish and assign one person to be the entity. Okay? And that way, the other 2 partners, right, they get to, act as a silent partner or whatever it is, right? And then number 4, no annual shareholders meeting is required. So again, for the central government, of course, if you do establish as one of that as a characteristics of part of being a corporation, that you have a central government, you're not obligated to have a shareholders meeting. You're not obligated to let other people who invest into your company know anything about your company because you are partnership, right? The only people that you need to talk about is the people who are in your company. Number 5, less admin work and record keeping. So in this case, right, so it's less work just because as a corporation, it's just less work. I don't know how to describe this one. Sorry, I had a brain fart. So again, it's less paperwork, okay? Whereas a corporation has a bunch of paperwork. So it's just less work just because you are a smaller kind of company, but you just have a few characteristics that act like a corporation, but at the same time, you're a partnership. So you would definitely have less work to deal with. Okay? And number 6, membership interest can be assigned. So we talked about membership interest. So that's people who want to either own a part of the company, right? You can assign interests, you can assign people specific interests. Okay, so if they're interested in being a part of the company, right? Because one of the characteristics could be a shareholder. You can actually assign some kind of membership to them. Okay. And then disadvantages, once again, if you are an LLC, you have to at least have 2 owners, okay? So we talked about partnerships, right? If it's a hybrid between a partnership and a corporation, right? The number one criteria in order to establish yourself as a partnership is you have to have more than 2 people, okay? If there's only one person, unfortunately, it's a sole proprietor. So you have to have more than 2 people, at least 2 or more people. Number 2, can have limited lifespan, just because, like we talked about it, if a partner leaves, then you're in trouble. Okay? If there's 2 of you and a partner decides to leave, then that's why the lifespan could be short. Okay? Number 3, may have self-employment tax. Once again, I'm not a tax accountant, so I don't know how much of a disadvantage this is. Just because if you're going into a partnership, I don't know how the taxes work for self-employed people if you establish yourself as a limited liability company. So in that case, it is a disadvantage. Okay. Number 4, if profits exceed 50%, it will be taxed by the federal. Okay. So, yes, we talked about profits, right? We talked about being taxed at income level as well as corporation level. In this case, it's saying that if you make profits larger than 50%, you will get taxed by the government. Okay. Number 5 says you cannot take advantage of stock options. So, stock options is going to be one of those benefit plans as if you want to retire, if you are a corporation, you can offer what's called stock options. So, when you do retire, you still have the option to redeem any stocks, or you can hold on to the stocks as part of your retirement benefit plan. Okay, in this case, because this isn't a corporation, it is, remember, it's still an entity, it's still a business. It's not a corporation, so you can't take advantage of stock options. Okay, you cannot use that as a retirement benefit. Number 6, some states tax LLCs. So once again, before you even consider, make sure you do look at the guidelines and rules on establishing yourself as a limited liability company. If you get taxed, you get taxed. If you don't, great. Okay, but once again, it's going to be depending on which state that you establish your limited liability status for, and it will determine whether you get taxed or not. So that could be a disadvantage because, once again, taxes as a company it's definitely annoying. Okay. And last but not least, number 7, going to be converting from an existing business into an LLC can be taxed. Okay, yes. Because if you are already existing as a small business, as a sole proprietor, for refiling back to the state or the local agency, whichever one that you go to, and you establish and change your status as an LLC, yes, you can be taxed for that. Okay. Any questions in regards to limited liability companies?
No. No.
Okay. Last but not least, the 5th and final organization that we have here is going to be non-profit organizations. Okay, these ones, right? Pretty straightforward. It says its name in there. Their goal is not to even make money at all. Their primary goal is to spread awareness, to educate individuals or even to the public about a specific topic, whether it could be charity, volunteer work, it could be religion, cultural, educational, right? It could be just to spread awareness about a specific idea that they believe in, all right? So all this is, it's pure voluntary, it's purely charity work, okay? And what it does is it's the primary purpose is just to educate and provide services to the public. That's it. Okay, as you can see, these the examples that I've located here on the PowerPoint here, right? PETA, not us PETA, but the animal PETA. Okay, the I think it's the protection of, well, it's protection against animals. I don't remember what the acronyms are, but PETA. Right, we got the Susan G. Komen for breast cancer awareness, right? We got the Comic Relief, which is for AIDS, okay? And we got the Children's St. Jude Hospital, which is primary research for children with cancers and disabilities, okay? So once again, these organizations, their primary goal isn't to make money off of you guys. The primary goal is to, one, do research, to educate the public about a specific awareness or some kind of, thing out there that they believe in, right? So they want to make sure that they spread awareness, and by doing so, again, they can use their logo or their company, right, to spread awareness and to be able to, use it as a charity option, okay? So once again, these nonprofits do not have any owners. No one owns these organizations. They are purely members who volunteer, okay? Okay, so not anybody can just sign up for, well, actually, yes, anybody can sign up for a nonprofit organization as long as they think that this is truly what they want to do as part of their community service or whatever it is, voluntary work. They can choose this because these organizations do charity work, okay? And of course, with that, they are funded usually by the members, right? By distributing membership dues, okay? So again, that's one of them. They can do contributions, right? Companies can contribute to these. So any major corporations that are trying to look good in the public eye by donating to specific charities, that's a good one that they can contribute money to a specific organization. So, for example, if Target wants to, fund for children, right? They can. I think they usually have that. Boys and Girls of America Incorporation. They usually do that one, or they have Toys for Tots. They do that kind of charity funding, right? They donate a bunch of toys to those organizations to help children's who's are foster or for adoptions, right? To have toys, all right? Whatever charity work that, that's going to be considered contribution, okay? Other things too is that these organizations, they can hold fundraisers, okay? Especially for Susan G. Komen, right? They are all about the breast cancer. So when it's breast cancer month, which is, I believe, in the month of November or October, I think it's October, November, one of those months is breast cancer awareness, right? Usually they'll host a huge fundraising event where they close down a whole street of LA and they do a walk. So anybody who, sponsors somebody in the walk or just for how many hours to do that whole walk, they're raising money for fundraising for these organizations to either one, do research for breast cancer, to, whatever they want to do with that money, right? Usually they try to tell you that the money is for spreading and helping them be able to, provide the education, but also the research for finding a cure for cancer. Okay. And once again, federal, state grants are usually something that they can fund them for. So again, state grants, right? If the state of LA is going to shut down a whole street, that right there, it costs money to do that, right? So again, all of those are going to be things that they are going to help to, to spread awareness, right? And again, they're for non-for-profit. So because they're non-for-profit, they get special taxes because they're not raising money in a sense to make a profit. They're raising money to either spread awareness, right? Now, most cases, a lot of for-profit organizations, they can seem to be corrupt just because a lot of times they always market saying that the money is going to go towards resources to research and whatnot, but actually a portion of that money does go to fund the people who are running the organization. So yes, they do elect people, but again, it costs a lot of money and time to be able to run over an organization, and not that many people are willing to do it for free. So again, most of the memberships dues do go indeed to pay for the CEO of the nonprofit organizations, but for those kind of ideas, yes, some of the money actually does go to help these people run the organizations. All right. Any questions here?
Nope.
Okay. Okay. So, I think right here would be a perfect place to stop. We'll talk about business activities, and we'll talk about the different areas of accounting. Okay. So right now it is exactly 2:51. Go ahead and take your nice 20-minute break, and and we'll be back at 3. I'll give you an extra minute. 3:12. 3:12.
3:10?
3:12.
3:12? Okay.
Okay.
All right. See you soon.
Okay. Bye. Bye.